If you don't pay attention to what I'm about to show you, you're going to watch your portfolio get absolutely demolished in the next 12 to 18 months. The S&P 500 has surged 77% since October 2022. 77%. That's more than double what a normal 3-year period delivers. And you know what? It's going to keep going. I predict we're going to see another 20 to 30% gains in 2026, maybe more. This is going to be one of the most spectacular bull markets you've ever seen. But here's what nobody else is telling you. This exact pattern, this exact setup preceded every major market crash in modern history. 2000, 2007, 2022. Every single time, we had massive gains followed by brutal, career-destroying corrections. And it's about to happen again. I'm talking about meme stocks, SPACs, dog-themed cryptocurrencies, all the crazy stuff. When people start saying, this time it's different, or Bitcoin will make me a billionaire, that's your signal.
The stock market's recent surge is unprecedented. Since October 2022, the S&P 500 has jumped 77% more than double the typical 3-year gain. Tech stocks are exploding. AI is the future everyone is betting on, and it seems like easy money is everywhere. The numbers look incredible, the momentum feels unstoppable, and optimism is overflowing. But beneath all the excitement, something dangerous is quietly taking shape. We've seen this movie before. Massive rallies followed by brutal corrections defined 2000, 2007, and 2022. Each time, markets soared to impossible heights. Investors felt untouchable, and then everything unraveled. History suggests the question isn't if another collapse is coming, but when. Now, Canadian entrepreneur and crypto commentator Kevin O'Leary is sounding both confident and cautious. He says the engines behind this rally are still roaring, and he believes the momentum could stretch deep into 2026. In his view, we're not at the top yet, not even close. But O'Leary also warns that markets don't rise in straight lines. The same explosive growth we're celebrating today has marked the final chapter before every major crash of the past 25 years. And there's another wildcard quietly waiting in the wings, which is Bitcoin. If this rally keeps accelerating, Bitcoin could rocket to levels we've never seen. But if sentiment snaps, it could just as quickly become the first domino to fall, dragging everything down with it. So the real question is, are we racing toward a historic breakthrough or blindly sprinting into the perfect financial trap? Let's hear directly from Kevin O'Leary for more insights. Please don't forget to like, subscribe, and enable notifications. Thanks for tuning in. Enjoy the rest of the video.
The S&P 500 has surged 77% since October 2022. 77%. That's more than double what a normal 3-year period delivers. And you know what? It's going to keep going. I predict we're going to see another 20 to 30% gains in 2026, maybe more. This is going to be one of the most spectacular bull markets you've ever seen. But here's what nobody else is telling you. This exact pattern, this exact setup preceded every major market crash in modern history. 2000, 2007, 2022. Every single time, we had massive gains followed by brutal, career-destroying corrections. And it's about to happen again. 2026 is shaping up to be a once-in-a-decade, maybe once-in-a-lifetime opportunity. Massive fortunes are going to be made, and massive fortunes are going to be lost. The question is, which side are you going to be on? Because by the end of this, you're going to know exactly when to make your move, what warning signs to watch for, and how to profit in both scenarios. Let me start by explaining what's driving this insane rally, because if you don't understand the fuel, you can't predict when it runs out. And when that fuel runs out, you better not be the last person holding the bag. We're up 77% since October 2022. A normal 3-year period gives you about 30%. We've done more than double that. Now, does that automatically mean a crash is coming? No. And this is where most people get it wrong. They see massive gains and they panic. They think, we're due for a crash, but that's not how markets work. Bull markets can run hot for years. In the 1990s, we had a 9-year bull market. In the 2010s, we had an 11-year bull market. So the fact that we've gone up fast doesn't automatically mean we're about to crash. The real question is not whether we'll crash because we went up fast. The real question is, What fundamentals are driving this rally and what will make them break? Let me show you the 3 obvious drivers that everyone talks about, and then I'll show you the 3 hidden forces that almost nobody understands. And those hidden forces are what's going to determine when this party ends. First, the obvious stuff. AI infrastructure spending. In 2026, global spending on AI infrastructure is projected to hit $400 to $500 billion. That's massive. Semiconductors, power grid expansion, data centers, cloud computing. Companies like Microsoft, Amazon, Google, and Meta are planning about $280 billion of that expenditure themselves. That's real money flowing into real companies. That's not speculation. That's actual capital investment that creates earnings, jobs, and economic growth. As long as that spending continues, tech stocks are going to keep climbing. Second, the Federal Reserve, they're going to cut rates. Trump's going to appoint a new Fed chair, probably someone who's going to be more aggressive about cutting. Why do rate cuts matter? Because they make borrowing cheaper for companies and consumers. Companies can invest more, consumers spend more. Either way, corporate profits go up, and when profits go up, stock prices usually follow. Third, retail investor FOMO. The fear and greed index is sitting at greed right now, and we haven't even hit extreme greed yet. You know what that means? All the people who sat out 2025, and there are still plenty of them, are about to start piling in. They're going to see everyone else making money and they can't stand it anymore. They're going to buy, and their buying creates more buying. It's a self-fulfilling prophecy. But here's where it gets interesting. There are 3 hidden forces driving stock prices higher that Wall Street knows about, but doesn't talk about publicly. And these forces don't care about valuations. They don't care about PE ratios. They just keep buying no matter what. First, index funds. Do you own an index fund? Of course you do. Your 401k does, your pension does, everyone owns index funds. And when money flows into index funds, they have to buy the stocks in the index. They don't have a choice. The S&P 500 could be massively overvalued, and they still have to buy. But here's the kicker. Most of that money flows into the top 10 companies. Apple, Microsoft, Nvidia, Amazon, they get the lion's share of every dollar that flows into index funds because they're the biggest stocks. So there's constant buying pressure on the biggest stocks, which pushes them even higher. It's mechanical, it's automatic. It has nothing to do with whether these companies are actually worth what they're trading at. Second, corporate buybacks. This year, companies bought $1 trillion of their own shares. 1 trillion. Why? Because CEOs and executives are paid in stock options. They make more money when their stock price is high, especially right before their options vest. When a company buys back its own stock, there are fewer shares available. Fewer shares with the same profits means the PE ratio looks better. It looks like there's profit growth. The stock must be worth more, right? That's how companies pump their own stock prices. And there's research showing a very odd coincidence that these buybacks are often timed right before executive stock options vest. I'm sure that's just a coincidence. Of course, the great and good American corporate world would never pump their own stock prices for personal gain, right? Third, options hedging. When you buy a call option, who do you think sells it to you? Market makers. Companies like Citadel and Susquehanna, they create the option and sell it to you, but now they have risk. They're on the opposite side of your bet. So they hedge that risk by buying the underlying stock or the index. That creates more buying pressure, which pushes prices higher. It's mechanical. Market makers don't care about valuations. They're just managing risk. But their hedging activity creates constant upward pressure on prices. So you've got index funds that have to buy, corporate buybacks that artificially reduce share count, and options hedging that creates mechanical buying. None of this is based on fundamentals. It's all mechanical buying pressure. And as long as money keeps flowing into these channels, stocks keep going up. But here's the terrifying part. When the market turns, these same forces work in reverse. Index funds have to sell when money flows out. Buybacks stop when companies have less cash, and options hedging flips from buying to selling. That's when things get ugly. Very, very ugly. Now I know what you're thinking. Kevin, the market PE ratio is 28. That's crazy high. Historically, it's been 16 to 17. We're massively overvalued. We have to crash. Wrong. And this is where amateur investors get destroyed. They fixate on PE ratios without understanding what drives them. Yes, we're trading at a premium, But that doesn't matter as long as the fundamentals I just explained are driving the rally.
O'Leary breaks down what is actually fueling this rally, and it is not just optimism. There are three obvious drivers everyone talks about. First, AI infrastructure spending is projected to hit $400 to $500 billion in 2026. Companies like Microsoft, Amazon, Google, and Meta are planning to spend about $280 billion of that themselves. That is real money flowing into real companies, creating earnings and pushing stock prices higher. Second, the Federal Reserve will cut rates. Trump will likely appoint a new, more aggressive Fed chair. Lower rates mean cheaper borrowing, leading to more spending, investment, and higher corporate profits. As profits rise, stock prices usually follow. Third, retail investor FOMO is building. The Fear and Greed Index is currently in greed territory, but it hasn't reached extreme greed yet. That means all the people who sat out 2025 are about to start piling in. They cannot stand watching everyone else make money anymore, so they will buy, and their buying will create more buying. O'Leary says there are three hidden forces that few people notice that still drive stock prices higher. Unlike typical buyers, these forces do not consider whether stocks are cheap or expensive. They buy automatically, regardless of valuation. According to him, understanding these forces is key to knowing what might end the rally.
In the late 90s, we hit PE ratios of 30. The market kept going up for years before it crashed. In 2021, we hit 30 again. And yes, we eventually crashed, but not immediately. The market kept climbing for months after hitting those levels. So PE ratios tell you we're expensive, but they don't tell you when the crash is coming. For that, you need to watch different indicators. Let me show you the three scenarios that could trigger a major market correction. Understanding these is critical because they'll give you advance warning before the crash happens. First, a weakening labor market. Unemployment is higher now than at any point since 2021. If unemployment keeps rising, people spend less. When people spend less, companies make less profit. When companies make less profit, they lay off more workers. It's a vicious cycle that feeds on itself. Now, the Fed will cut rates to stimulate the economy, but that might not be enough if the cycle has already started. And remember, rate cuts take time to work. By the time they kick in, we could already be in a recession. Second, stagflation. This is the worst-case scenario. Stagflation means slow growth with rising unemployment, but inflation remains sticky above target. So inflation stays at 3% or higher, GDP growth is weak, and unemployment is rising. In this scenario, the Fed is trapped. They can't cut rates aggressively because inflation is still high. They can't stimulate the economy without making inflation worse. And the government can't spend much more because they're already running $2 trillion deficits. It's a nightmare scenario with no good solutions. Third, extreme valuations meeting earnings disappointments. This is what I'm most worried about. The PE ratio of the S&P is 28. If companies start missing earnings, if growth slows, if AI spending doesn't deliver the returns everyone expects, valuations will collapse. Imagine NVIDIA comes out and says they only grew 30% instead of the expected 60%. The stock crashes. When NVIDIA crashes, it drags down the index. When the index falls, index funds have to sell. When index funds sell, they dump the top 10 stocks. Everyone panics because everyone owns the top 10 stocks. They sell more. Index funds sell more. It becomes a cascading collapse. We've seen this movie before. In 2000, the S&P hit a PE of 30 and then dropped 50%. 50%. Half your money gone. In 2021, we hit 30 and dropped 25%. So yes, it can happen, and it will happen. The only question is when. Let me tell you exactly how I think this plays out. First half of 2026, euphoria. Big market surge. Everyone's making money. Tech stocks are flying. AI is the future. Everyone's a genius investor. We could easily be up 20 to 30% by mid-year. Then middle of 2026, maybe a bit later, maybe conveniently after the midterm elections, reality starts creeping in. Unemployment ticks higher. Earnings guidance gets cut. Some major tech companies disappoint. Inflation is still there because the Fed cut rates too aggressively. End of 2026 or early 2027, the hangover hits. People realize we partied too hard. Valuations are insane. Fundamentals don't support these prices. The sell-off begins, and it's brutal. Is this doom and gloom? No. This is just the cycle of markets. Markets move up and down. They always have. They always will. The question is, are you going to be smart enough to capture the upside and avoid the downside? Or are you going to ride it all the way up and all the way back down like most retail investors do? Let me give you 5 specific warning signs. When you see 3, 4, or 5 of these flashing red at the same time, it's time to get defensive. It's time to take profits. It's time to protect what you've made. Warning sign number 1, speculation going parabolic. I'm talking about meme stocks, SPACs, dog-themed cryptocurrencies, all the crazy stuff. When people start saying, this time it's different, or Bitcoin will make me a billionaire, that's your signal. When garbage stocks go up 100, 200, 500% in a few weeks, the top is near. This means dumb money is entering the market, and I'm not being mean, I'm being factual. The last money to enter bull markets is always the least sophisticated. They chase momentum, they buy whatever's hot, they have no risk management, and when they start flooding in, that's your exit signal. Warning sign number 2, normalized crazy returns. If everyone's saying, I only made 40% last year, isn't that terrible? You're at the top. When people are disappointed with 40% returns, they've lost all perspective. The market historically does 8 to 10%, not 30 or 40 or 50. When people expect 50% every year, we're in bubble territory. Warning sign number 3, margin debt. As I'm recording this, there's about $1.2 trillion in margin debt. That's people borrowing money to buy stocks. Don't do this unless you have extraordinarily sophisticated risk management. Most people don't. When the market goes down and you're on margin, you have to come up with cash or your broker force sells your positions. Guess when they sell? At the bottom. The exact moment you should be buying.
Leary reveals the hidden forces mechanically driving stock prices higher, specifically, the automatic buying of large company stocks by index funds. These funds must purchase shares of the largest firms in the index, such as Apple, Microsoft, and Nvidia, whenever new money flows in. This creates persistent buying pressure on these top stocks, regardless of their underlying fundamentals. The process is systematic and unrelated to whether the companies are actually worth their current trading prices. Second, corporate buybacks. This year, companies bought $1 trillion of their own shares. When a company buys back its own stock, the number of shares available decreases. This reduction in supply can drive the stock price higher, benefiting shareholders. Fewer shares with the same profits also mean the PE ratio looks better, suggesting profit growth. CEOs and executives are paid in stock options, so they stand to gain when the stock price is high, especially right before their options vest. Leary points out research showing these buybacks are often timed right before executive stock options vest, implying a potential incentive that aligns executive compensation with buyback timing, which he says is surely just a coincidence. Third, options hedging. When you buy a call option, market makers sell it to you, but now they have risk. So they hedge that risk by buying the underlying stock or index. That creates more buying pressure, which pushes prices higher. It is mechanical. Market makers do not care about valuations. Leary explains that as long as money keeps flowing into these channels, stocks keep going up. But here is the terrifying part. When the market turns, these same forces work in reverse. Index funds have to sell when money flows out. Buybacks stop when companies have less cash. Options hedging flips from buying to selling. That is when things get ugly. Leary lays out 5 specific warning signs to watch for. When you see 3, 4, or 5 of these flashing red at the same time, it is time to get defensive. First, speculation is going parabolic with meme stocks and dog-themed cryptocurrencies. Second, normalized crazy returns where people are disappointed with 40% gains. Third, margin debt is spiking as people borrow money to buy stocks. Fourth, the fear and greed index is hitting 80 or 90. And fifth, your own behavior, checking your portfolio every hour and feeling invincible. Leary believes the first half of 2026 will be a period of euphoria, with big market surges and everyone making money. Then, in the middle of 2026, maybe after the midterm elections, reality starts creeping in. Unemployment ticks higher, earnings guidance gets cut, and some major tech companies disappoint. By the end of 2026 or early 2027, the hangover hits hard. People realize valuations are insane, fundamentals do not support these prices, and the sell-off begins brutally. So what do you think if O'Leary prediction comes true? Will you take profits during the rally, or are you going to ride it all the way up and back down again? Please, let's have your thoughts in the comments below. Thanks for watching. Don't forget to like and subscribe.